Welcome back, Theta Gang Warriors, to our second video on intermediate Theta Gang strategies. Last week we explored the put credit spread, which is a bullish position with limited downside risk. And this week we are going to explore the inverse of that, known as a call credit spread. Mechanically, both credit spreads operate similarly, so if you haven't seen the video on put credit spreads, check that one out first and then come back and join us here. The call credit spread is a slightly bearish position, a bet that stocks will go down or stay the same. But just like the put credit spread, the call credit spread automatically limits your losses if the trade goes against you. Specifically, the call credit spread is a valuable, and I'd argue necessary, alternative to just selling naked calls, which is way too risky for the average trader. This spread can also help you hedge against unexpected price increases when you sell covered calls. Good stuff, right? So how's this thing work? Let's dive in. The backbone of a call credit spread is a short call. That is, we expect the price of a stock to not increase, so we sell a call to collect sweet premium. However, selling calls is very risky, so we limit our risk by buying a call at a higher strike. The call that we sold will always be more valuable than the one we bought, so we are credited the difference. We are now holding most of our premium, and we are holding a long call. But this begs the question, why did we do that? Why are we giving back some of our premium to buy a call when we expect the price to go down? Why not just sell a call and be done with it? And the answer is this. Remember that when you sell calls, you are agreeing to sell 100 shares of stock at the strike price, regardless of what the stock is actually trading at when the option gets executed. If you sell a call at the $30 strike and the stock goes up to $100, you are on the hook to buy 100 shares of stock at $100 and then turn around and sell it at $30. If you don't have the cash on hand to settle that $7,000 loss, you will either suffer a margin call or somehow come up with the cash to buy back that call that you sold at a tremendous loss. For that reason, selling calls is unlimited risk. To make it worth it, we need to convert this naked call into a call credit spread by trading some of our premium for that long call. It's going to act as insurance for us, so let's use an example to demonstrate why this is so important. Let's pretend you sell a call on Apple at a strike of $240 and collect $500 in premium. You are taking a bet that Apple will close below $240 on the expiration date. If it does, you will keep the full $500 premium and have realized the maximum gain on this trade. Since we collected $500 in premium, our break-even is $245. If Apple closes between $240 and $245, the premium will balance out with the loss, and we can still profit. But if Apple closes above $245, we will face a loss. Imagine if Apple were to close at $250 on expiration. We are still on the hook to sell at $240, so our brokerage would buy 100 shares at $250 on the open market and sell them at $240 to fill that obligation. We would have lost $500 after accounting for the $500 premium we collected. Or, if you have margin, you might assume a short position at $240. You're still looking at a loss. Just to exaggerate to show you why the risk of naked calls is so high, let's pretend the iTime machine comes out and Apple closes at $400 on expiration. You still have the obligation to sell at $240. Now, you're looking at a loss of $15,500 while pursuing a $500 gain. That's the naked call for you. Is it worth the risk? Probably not, but we have a solution for you. We are going to convert this naked call into a call credit spread by adding the purchase of a call at a higher strike. This will limit our losses. So let's convert to a call credit spread and then relook this example. In our new scenario, we still sell the Apple 240 call for $500 in premium, but let's spend $200 of that to buy a call with a strike of $245. This will give us a total net credit of $300, so that is our new max gain. Our break-even will also shift down to $243 since we collected $300 in premium instead of $500. But here's the payoff. We always have the right to buy Apple at $245 now. Even though we are obligated to sell at $240 because of our short put, we can buy at $245 if Apple rises high. Our max loss is now the difference between strikes minus the $300 we netted in premium. Our max loss is now $200. Now that we've capped our loss by converting to a call credit spread, when the time machine comes out and Apple rockets to 400, we'd still lose only $200. We would get our call assigned and sell at 240, then we would execute our own 245 call to cancel out, giving us a loss of $500. Minus the $300 premium that we always get to keep, we have a $200 loss. This is much better than the $15,500 we would have lost if we used a naked call instead of a call credit spread. Just as an additional note before we wrap this up, most of the time when you're selling calls, you're selling covered calls. So if the share price rises above your long call in this case, your call goes back to making money instead of just capping your loss. This is just my visualization for practical purposes because I plan on staying long the shares for the long term, but my diagram looks like this. The area between the break even and my long strike is the only max loss. After that, my call goes back to making money again so I can seek those big gains. Again, there are more technically accurate diagrams because this one does not show that when you're holding shares in a covered call, you can actually suffer a loss if the share price goes down too significantly. When that happens to me, I typically leave those losses unrealized and then just sell more covered calls, and for that reason, I don't include them in this model. I encourage you to consider whether or not you agree with my view of covered call credit spreads. If you don't share my view of the wheel, keep in mind that you can also suffer a loss by virtue of holding the shares. Either way, this shows that you can still cheer for your stock to rise even if you have a bearish spread. The point is that call credit spreads are useful even if you're selling covered calls instead of naked calls. And for those who have a really hard time in life, we're going to walk through how to actually set this up on Robinhood. So of course we're going to start by opening up our stock. So we'll select Apple, and then we're going to go to the bottom right and we're going to trade Apple options. We want to give ourselves a decent amount of premium, so let's select an appropriate date of expiration. Let's go 2 weeks out, and we will start setting up this spread by selling our call. Let's select one strike out of the money, and now we will go up here and we're going to buy the other leg of this spread. Let's scroll up one more time, and I'm going to select the 257.50 strike. And you can see here that we have now set up a call credit spread. This spread looks like it will credit us about $203 depending on our limit price. And of course my account is not set up to handle $750 of collateral right now, but this is how you set it up. The collateral is actually also the max risk, which is the distance between the strikes, but of course we must also account for the $203 we collected in premium, and we always get to keep it. So our true max loss is $547. We are now rooting for Apple to close below 250 on November 15th. And that's about all there is to it. That is the call credit spread. That's all for this video. I hope you guys see the value in incorporating call credit spreads into your inventory. Next week, we're going to step it up further by exploring the strangle strategy. Make sure to subscribe so that you can keep up with all the action. Thanks for watching, and I'll see you next time.